Hello everyone, my name is Tze Kang, the expert tutor of Advanced Financial Management, AFM. This video will be discussing on one of the key areas of the syllabus, corporate restructuring. In these sessions, the discussions on corporate restructuring will be mainly referring to the following resources from the ACCA official website. That's including, first, on Study Hub, from Chapter 9, second, technical articles with the title Business Valuations, and last but not least, ranges of past examinations questions pertaining to the topic that is found on the practice platform. These discussions on corporate restructuring will first take you through to understand the background, the pictures of what exactly corporate restructuring exercise is all about, followed by to understand what's the reason, what's the rationale behind businesses, organizations to undertake those activities. Thirdly, how are we to evaluate the impact or the effect of such change on ranges of aspects that is required in the examination. Finally, let's take a look at some application into one of the examination's questions in the AFM exam. So, what exactly is corporate restructuring, guys? And the answer is, it refers to three main types of restructuring exercise, which namely, type 1, it is called as the organizational restructuring. Let's get to understand the meaning of it with some examples illustrated. From there, it will also accompany by understanding the reasons of such changes that take place. The organizational restructuring, it's mainly referring to a change in the structure, the setup of a business organization. Among all types of such activity, the common one, especially from the perspective of AFM exam, it's about a change from centralization to decentralization of the business structure, in particular, the treasury functions within a business. Why would businesses are keen to move from centralizations to decentralizations? And obviously, the answer of that reason is to have a better fit to meet the growing business size and scale in order to allow and empower manager of each respective responsibility center or even the treasury function to have the autonomy to take appropriate decision in responding to the rapid market changes, which especially will escalate the reason of such change. Apart from type 1 of corporate restructuring, here comes the second type of corporate restructuring that involve a restructuring on the capital component or the long-term fund component within the business. In simple, such restructuring exercise is involving a change in the compositions of the two main types of long-term fund, namely the elements, the component of equity financing as well as the debt financing. Here are the three common types of examples that involve in the capital restructuring. 1. A company would attempt to increase the equity base by issuing additional share via right issue or private placing, for instance, with the attempt to repay and therefore reduce the level of the debt financing. Vice versa. For certain reason, if the firm would like to take advantage of the benefit of debt financing, they would have raised additional debt by taking up a bank loan or issuing bonds or loan notes with the attempt to return or refund some of the share capitals back to shareholders via share buyback. And last but not least, in an undesirable incident where the company have no choice but to undergo capital reduction in order to safeguard the presence, the survival of the firm, that is when both the value of equity and debt were expected to be impaired and reduced via a series of capital reduction schemes. Why would there be a change on the capital's component? And the reasons behind of that is obviously part of the turnaround strategies that will involve with the change in the compositions of the capital to make sure it will prevent from the voluntary or mandatory liquidations from happening that will lead a winding up situations for the firm, which all the business organizations given the choice would like to get rid of it. That explains why capital restructuring is a need to be there. Finally, apart from the first two types of the corporate restructuring, here comes the third one, which is also the main area of the examinations in AFM. That is about portfolio restructuring. In simple, it is about the change in the business compositions or the business activity that owned by a corporate. There are two main types of portfolio restructuring exercises within the syllabus. First, unbundling. It is about separating, detaching all kinds of the business compositions with the preparations to undergo a series of demerger exercises. Alternatively, to have a spin-off exercise. Guys, you are advised to read up the content in the study hub and your own learning materials to understand the meaning of such terminology. Apart from unbundling, the other type of portfolio restructuring, it's about disposal, letting go the business activity or divisions that are owned by the corporates. A ranges of divestment strategy, such as sell-off, management buyout, management buy-in, last but not least, institutional buyout are the ranges of commonly seen divestment strategy to get rid of certain businesses' activity. Before looking at the reasons behind, it is worth noting, as far as selling off a business is concerned, that is a kind of a disposal of businesses from the seller's company's viewpoint. However, try imagine by putting yourself into another side of the shoe. Whoever that bought over such business's division, who is now become the buying company, why would you think the buying company would be keen to buy over or take over such businesses? And the answer is that would probably be giving rise to the case of an action of merger and acquisitions from the buyer's company's perception. So now let's come back to the divestment strategy. Why is there a need? What's the reasons behind such move, as well as the move to have an unbundling move among the corporates? Here are the answers. The main reasons to undergo unbundling strategies, such as demerger and spin-off, it is simply to allow the unleashing of the true values of the enterprise that believe at this moment it is underestimated or undervalued. Alternatively, such move will be an early preparations for equipping and facilitating any merger and acquisitions activities that will take place in the future to have a better layout and a corporate structure after the M&A. How about the reason of undergoing disposing of, selling off certain investments or business activity? This move is seen to be a form of a reallocation of financial resources, which is about the cash resources that used to be owned by the businesses. Why would they be keen to reallocate such cash resources? And the answer is obviously there could be a change in the underlying mission of the firm. The reason of presence in the market would have changed, or there could be a major change in the strategy or the directions of the businesses. Last but not least, changes in external businesses environment may have rendered certain industry to be on the sunset, and therefore it will make more sense for the businesses to relocate the financial resources to another industry that is uprising based upon the finding as denoted by the pastel framework. These are therefore the ranges of reasons in explaining why are there a need to undergo three main types of corporate restructuring exercises. So guys, once we get to understand the reason, now let's come to the how examinations questions will be tested on. it is kind of common that the questions would ask the candidates to assess or to evaluate the impact, the effect, in simple, the changes from the above on a particular aspect which is required in the exam's questions. For type 1 change, where there is an organizational restructuring going on, such as decentralizations of, for instance, treasury function, it is common that the questions may ask, could you evaluate what's the impact of that change onto the strategic fitness with all the recommended changes? To answer this kind of questions, it is purely discursive in nature. What you have to do is to highlight the pro and cons, the positive aspect of the changes. Say, for example, a decentralization of treasury function would have given rise to a more quicker and a more on-time response to the needs of financing activities or managing the risks that are arising in each of the division. However, on the downside of such decentralizations move of the treasury function may would cause the businesses to forego some opportunity to enjoy economies of scales due to a smaller scale and sizes of financing activity or exploring the suitable type of hedging techniques for managing the risk. So guys, this is how you evaluate the pro and cons of the above change regarding the organizational restructuring. How about the second type of corporate restructuring on capital? What kind of evaluations would claim to be asked? Here is the example. It is likely for the questions that ask the students to evaluate the impact of that change on the long-term benefits that belongs and attributable to creditors, both secured and unsecured group, which are mainly the lenders. And finally, how would that change affecting the interest, the benefit for the shareholders? And these are mainly refers to examining the change in the value of assets that owned by the creditors and the shareholder, such as looking at the changes in the value of the bonds for the bondholder or the changes in the value of share capitals for the shareholders. Other than the assessments of the impacts from a given capital restructuring, here comes the third and the final type of restructuring exercise as discussed earlier, which is the key and the attentions of this video session. How would the questions expect to carry out an evaluations on the effect of such portfolio restructuring given ranges of financial indicators of value? Here are some examples. It is common that the evaluations will be asked on how do you think the above change would affect the financial performances that shown in the statement of profit or loss? How would that change affect the result of the financial position by preparing a forecast statement of financial position? More commonly, guys, how would that change affect the series of financial values, such as when there is a portfolio restructuring, key financial ratios such as gearing, earnings per share, PE ratio, price earnings ratio, and etc. would be affected. If, take for example, a form of divestment is involving the selling off of certain businesses, that would definitely affect the earnings ability, and therefore the EPS may be affected, and so is the PE ratio, which will affect the perceptions of the shareholders' confidence level on the company's future earnings ability. Apart from the key financial ratios, ranges of financial values such as the cost of different type of capital, cost of equity, KE, cost of debt, KD, and therefore weighted average cost of capital, WACC, would all get to be affected as a result of ranges of portfolio restructuring. You are therefore required to remember and to be able to apply the following models that derive all the respective financial values. Before I take you through to the list of the models, It is not the purpose of this video to hold hands in going through in detail to understand the mechanism, the technical aspect of each and every model. But the purpose of this video is to highlight to you what are the ranges of tools that is made available to derive the stated and the required financial value in order for you to have a more systematic way to organize the knowledge that require in dealing with such questions on restructuring. So here are the lists of the model. For deriving cost of equity, models that are commonly tested in exam are like capital asset pricing model. Alternatively, the Modigliani and Miller Proposition 2 model. Last but not least, the dividend valuation models. As for cost of debt, in particular for bond securities or loan note security, if the bonds that mentioned in the questions is already present in the company, or we call existing bond, the derivation of cost of debt is obviously based upon the yield to maturity that is according to the bond valuation model in use. And again, guys, the purpose of this video is to highlight what are the models and tools that is made available instead of showing the detailed steps of the calculations that will not be found in this part of the video. As for whether the bond is of existing, if the answer is yes, then the former approach applies. However, if the bond is a newly issued bond, then according to what you should have learned in other part of the syllabus, the data that we use to derive the KD will start referring to the annual spot yield, ASY, perhaps together with the considerations of credit spread, given that if the ASY carry different risk class with the bond that is newly issued by the firm. And again, it is still going back to the underlying model, the bond valuation model in use. With all these data on cost of equity and debt, it would not be a problem at all to derive the WACC. These would be the second set of the financial value that would be likely to be asked to evaluate and assess on the change. Here comes the third and the final set of the financial values that will be tested in exam. That is the value of ordinary share, which is also reflecting the shareholders' wealth of the firm. And secondly, the value of the bond. And guys, this part of the video is to show you the list of the models in use to derive the value of both the securities. For the valuation of share, the three common methods and base will be tested and required in the exam of most of the examinations questions. The net asset base, the PE ratio based, and thirdly, the most tedious one, the free cash flow valuation method, which can either be based upon free cash flow to the firm, FCFF, or free cash flow to the equity, FCFE. And not to mention a few other models for valuing the share. The first three are obviously the most commonly used ones in deriving the value of the share, which reflect the shareholders' wealth. As for bond, the only models that involved will be the bond valuation model as mentioned earlier. And again, it will still be requiring the discount rate to determine the present value of all the future cash flow for the bond. And that discount rate would base upon either yield to maturity or out of spot yield, according to the types of bond that the questions is testing on. Once you know the list of the models in deriving the ranges of the value, here comes the main challenge. How are we to carry out the assessment, to look at the impact, the changes on the following financial values? I would therefore give you a suggestion that denote in note 1 to apply it whenever there's a calculations involved, such as relating to type 2, capital restructuring, and type 3, portfolio restructuring. So these are the steps and approaches that is recommended to you to apply so that you will be able to come up with a more systematic way of answer layout. I call these as a 4 steps approach. Step 1. In order to assess the changes, you have to understand and derive the current value of those items before the change. And usually, these figures are pretty straightforward based upon the given data from the questions. Step 2. You will then need to derive the revised or the new value of the same item, but after considering all the affected item after the change. From these two sets of the value, that obviously it will show some differences. Step 3 will require a comparison of the two sets of financial value, taking the value in step 1, comparing to step 2 to figure out the differences. And very likely, the questions would expect the candidates to give a commentary on the change, whether it has caused an increase or decrease of it. Finally, it is likely the questions may ask to recommend whether it is a good idea to accept and carry on with such changes. So you will base upon the commentary, particularly looking at the impact to the wealth of all classes of stakeholder, that's particularly including shareholder and even the bondholder. From the commentary in step 3, that will give you a ground to give a recommendation. But bearing in mind, any recommendations that you provide, it need to be clearly justified. So guys, these are the 4 main steps that I will recommend you to consider applying whenever the questions is asking to evaluate the impact of the change on the following list of the financial value. Now it's time to take a look at how these 4-step approach will be applied to the following questions. Again, guys, the purpose of this video is to show the formation of answer planning based upon the step and the model that we have discussed. It is not meant in this part of the video to show the detailed answers in producing all the detailed calculation, in showing all the steps in the Excel. That is not part of the content in this video, but it is more focusing on forming the answer plan, which serve as the fundamentals to produce the final answer at the end in the exam. Looking at these questions, the requirement is focusing on A, B, and C. The discussion of this video on the answer planning is mainly on part A of the requirement, which divided into A1, that is involving in the calculation on the expected sale price of a business on coffee shop. This is clearly asking to derive the value of the businesses. Secondly, you are required to calculate the impact, which is what we have mentioned earlier. The impact of the sale of the businesses, that is clearly a sell-off. Guys, what is important is this keyword. What is the impact on the company's performances? This is the one that you need to show in your answer. Clearly, there are 3 sets of financial values that you have to show its change. The forecast statement of financial position, the forecast earnings per share, and the WACC, as all discussed and mentioned a while ago. So what you have to do is to go back to the story, and guys, you are highly recommended to, before listening to the following diagnostic of the answer planning, you should spend some time to take a look at the details that found in the following exhibits and try to figure out how are you supposed to make use of these data in developing the answer for part A1 and A2. So here are some of the tips and advices for you. In the first exhibit, which is talking about the background of the company CC, these are the information clearly relating to requirement B and C, highlighting the nature of the business at this moment, which is starting with a coffee shop business operation. And then the businesses expanded into fruit juice operation. And from the changes as described in the storyline, there is a plan for the company to dispose of the coffee shop businesses where there are a few interested bidder. And obviously, the last paragraph in this exhibit is to show an alternative view as given by another non-executive director. So guys, spend some time to go through the storyline to attempt part B and C. But what that is important in this part of the video is to show you how exactly the second exhibit that is about the sale of the coffee shops that we're involved with. The sale price of these coffee shop businesses is obviously derived based upon the guidelines given. And looking at these words, that is clearly the application of free cash flow valuation model that will be used to derive the value of the businesses. So from all the information given, you should be able to walk through the entire processes and the step in the free cash flow valuation to derive the value of the coffee shop, as discussed and mentioned earlier. As for the second part of the exhibit on 3, that is clearly relating to part A2 that was asking to evaluate the impact on the statement of financial position. The current financial positions as given here, it's comprising of the 2 existing businesses. So this set of the figure is clearly representing result before any changes. In order to assess the impact, as we say on the 4-step approach, you will just have to copy the entire template into the Excel response option, and then it will then, based upon the original value, you will then have to set up another column on after the change, after the disposal. What would this revised value be? So with the 2 set of the statement of financial positions, making a comparison, that will form the basis of a commentary. Finally, with the ranges of other information in Exhibit 4, that is clearly another part of the storyline relating to answer part A2 in determining the impact on the change on the forecast earnings per share and the WACC. Based upon the formulas that you should have learned in other part of the syllabus, the following are the key information allowing you to derive the forecast earnings and the forecast number of shares that will be used to calculate the forecast earnings per share. With information such as cost of debt, beta, these will allow the students to determine the cost of equity and the cost of debt in order to form the input data to derive the WACC. And you are required to, based upon this information, to calculate the result of EPS before the change and the EPS after the change to see the differences. And you also required to derive the WACC before the change and after the change to make a comparison for the commentary. And this will shows the applications of the ranges of models and steps in tackling and forming the answer plan of these questions. So you are required to take on the step to move further to produce the full scale of answer before referring to the model answer.